Hi, good evening, everyone. Thank you all for waiting. We were just waiting for a couple more people to log in with us. Looks like most of you guys have logged in. Hi, welcome to today's webinar. We'll be looking at technical analysis. My name is Vivian. I am a senior financial analyst at Century. Today, we'll be mainly looking at technical analysis and how we can use technical analysis to look at trading opportunities in the market. Before we go ahead and start, I have a small poll that I need to take to understand what level of expertise you all could have, and that would help me to structure the webinar according to the experience that most of you guys have. So I'm just sharing the poll with you. Let me know if you guys can see it and answer it. I've just published the poll. Please take your time and answer. So basically, scale your level of expertise from 0 to 10. If you're a very new beginner, please choose 0 to 2. If you have a little bit of experience, 2 to 5. If you're very well experienced, 5 to 10. Just give one more minute. All right, perfect. So looks like most of you all are very new. I have 56% of the participant who are 0 to 2 and the rest 2 to 5, which is good. Let me start off with the most basics, and I will try and make it as simple as possible and not complicated for you all. Let's get the objective of this analysis that we are going to look into. Technical analysis is used by traders to identify potential entry opportunities. Now, technical analysis not just gives you a good indication as to where to enter, it also gives you a good indication as to where you need to exit. And the exit could be a profitable trade, or it could even be a loss trade. Now, every trade that you take has a risk element to it. There are a few fundamental bases that I would like to touch upon before we move ahead. One is we need to understand every decision, every analysis that we see online or we find outside all comes with a risk. It all comes down to how disciplined we are with the risk management, and that is what is going to eventually show the success ratio of all the trades or investments that we do. Let's move ahead to start off with a few technical indicators that which would help you identify good opportunities in the market. Right, so I've already touched upon technical analysis. Now there are also two types of analysis that any investor or a trader would do. One is the fundamental analysis and the other one is the technical analysis. Anyone who is looking for a very long-term investment opportunities, I would always recommend do fundamental analysis. Fundamental analysis includes studying about a particular product, a company, and identifying if it has a growth opportunity for the next couple of years. And for you to identify, you need to look into the company's fundamentals. You need to look into the company's revenue, their business module, and see if the fundamentals are suitable for the next 2 to 3 years. Where compared to technical analysis is more of a short-term investment. Technical analysis helps a trader or an investor to take advantage of a very small time frame. If you're looking to take a trade today and exit it within this week, or it could also be for traders who are looking to take an exit when the market opens, when the US stock market opens, and exit before the market ends. This is where technical analysis will play a bigger part more than fundamental analysis. Now, moving ahead, there are few key indicators. There are multiple indicators which is available for you to use to identify good opportunities in the markets, but I'll be covering 2 or 3 of them for the day. One is relative strength index. So basically, relative strength index, I will not get into how the calculation of relative strength index is. I would encourage you guys to do some homework on it and understand how the calculation is done behind it. And of course, if you need more advanced studies only on the particular indicator, you can always reach out to us and we can do one-on-one session. But I will just give you a brief overview of what a relative strength index actually does. Basically, relative strength index shows you the strength of a market. Let's say, for example, if you're looking at gold and if you're looking at a daily time frame, it kind of gives you a good view into the markets as to whether the strength for the upward momentum is picking up or if the strength for the upward momentum is coming to an end. If we look at any market, it's usually trending or it is sideways. And especially when it is trending and you would like to look at where the market is heading and how much of strength is there in the market to move forward, RSI helps you out with that. I will also show you a couple of live examples from the chart on the live chart so that you'll be able to understand how RSI is used to identify the strength in the market. Moving ahead, here's an example of gold on a 4-hour chart, right? I've just marked out a normal candlestick. If you all do not know how to read candlestick charts, do not worry about it. Just look at these charts as to the peak and the bottoms it has made. So basically you will see there was a peak and then there's a bottom. I have just circled it with green circles. These are the peaks and these are the bottoms. How easy would it be if I knew this was the exact bottom? Wouldn't it be amazing? I take a buy here so I can profit from it. Or let's say I took a buy at this point and it went to a certain level and it started dropping. How easy would have been for me if I could identify this entry and also identify an exit. If I could find an indicator that does this for me, that would be one problem solved. In fact, the main problem solved for us. However, as easy as it may look right here, it is not that easy when you practically apply it. And I will also show you the drawdowns of RSI. Now, let's say on what basis have I circled these levels? Now, I'm just going to apply RSI to it. All right. At the bottom of the chart, RSI is an oscillator, so it's always at the bottom of the chart, which shows you the upside and downside strength. Now, RSI is basically made out of 0 to 100%. Every time it goes above 70, that means RSI, it is at a very overbought region. We have a lot of people who have bought into it quite heavily. I'm sorry, yeah. So if you look at, let's start at the first circle that I see over here. If you look at this peak and if you look at RSI is indicating it is above the 70% and it is at overbought region. So hence you could get ready to see the market dropping from these levels and vice versa. RSI came below the 30% mark, right, which indicates heavy oversold region. Every time it is below 30%, it indicates that the particular instrument, stock, be it commodity, be it currency, is oversold. That means you can expect the buyers to come back into the market and buy back into gold. Now, like I said, if this was a good indicator and I had to buy it at this price, the next question is, where do I exit? And once again, once the RSI went above the overbought region, you got an indication to exit. Now, I know this chart makes it looks very simple for you to enter and exit, and it looks like you can pretty much take a trade on every dip and make money. However, it's not as simple as that. An RSI can remain at overbought and for a very long period of time. We also need to consider the period of time that we are looking at. And of course, I have not yet given you the stop loss aspect of it. Every trade needs to have a risk management allocated to it. If I took a buy on gold at this price, I will also make sure I will keep a stop loss below this. Now I will show you how to take an entry, keep a stop loss and take profit using RSI while I'm doing the live demonstration to you all. Moving forward, the next thing that a trader or a investor should always keep in mind is to understand the product one, and to understand how many dollars or how much percentage can a particular instrument move in any given time frame. If I'm looking at gold for 30 minutes and I want to take a trade for the next 30 minutes expecting it to go up, I also need to know how many dollars can gold move in my favor. And that is where your average true range comes into play, and which gives you a good indication to identify how many dollars gold or any instrument could move. Let's look at an example of an average true range. At the bottom that you see in the black line chart is your average true range. Now I've taken gold chart on a daily basis. Basically, it is showing me data all the way from December 2019 up to today. And you can see there's a good flat movement till February, and from Feb to March the volatility increased because of the COVID-19 situation, and then again you see this price coming down. What is this ATR actually trying to indicate to me is that at today it shows 33.04. So this is indicating to me on a daily movement we can expect gold to move $33. Now, when I say gold can move $33 a day, it can mean either direction. It does not give us direction of the movement. It only gives us an approximate average price it can move. It can be a move of $33 on the downside. It can also mean it can go up by $33 on an average on the upside. Now, however, this is an average that is taken out of all the price movement that has happened in history. So if I have to look at gold, I look at the average of this entire history, and I see gold pretty much moves around $20 on an average every single day. On high volatility days like the one that you see in February, March, gold was moving about $50 a day. And that's a very high volatile moment for markets. One more word of caution that I would like to also tell you all before I move ahead is we are closing into US elections, and please be alert that there could be a lot of volatility that is going to pick up in the next coming weeks and months till the election time. There could be gold could start moving maybe even $40 a day, and maybe even $50 a day. This year has had most of the events moving the markets in all directions, and I would always caution you to be ready to see any kind of volatility. I will also, while I'm explaining to you all how we are going to take an entry and exit, I will also show you all how to use leverage, and best is how to avoid using leverage and trying to be profitable by the end of the day. Let's look at gold. Now it is the same ATR that I've used, but I'm looking at a 30-minute time frame. So basically I'm looking at the data from 14th of September to date, and every candle that you see within these green and red candlesticks are 30-minute time frame price range movement. Now let's look at what is 30 minutes showing me. In a 30-minute time frame, it shows me that gold can move $4.4 in my favor. So basically $4.4 either up or either downside, right? So if I happen to take a buy on gold right now, I can expect it to move by $4 on an average probably in the next half an hour. And not necessarily every half an hour it has to move $4. We again take an average of the entire movement that has happened from 14th of September till date, and we see gold actually moves about $2.5 to $3 maximum every 30 minutes. Now, why is ATR important? Now that you know how many dollars gold can move in the next 30 minutes, and if you're using your RSI to take a buy, let's take this as an example. RSI was at oversold, and you're looking at a 4-hour chart, and you're trying to take a buy for let's say a very short-term time frame. Now you can always calculate in 30 minutes if it can move about $3 to $4. Probably in the next 4 hours you can expect it to move maybe roughly about $12 in your favor or against you. So when you when you take a buy or you invest into gold, you always aim to make about $10 to $12 on the upside. At the same time, always keep a stop loss. If you're planning to make about $12, always keep a stop loss of $6. So that is your 1:2 risk reward ratio. Again, I will show you a couple of examples on the live pricing. Let's go ahead. Now we've learned RSI, we've learned ATR. Let's look at something that is even more interesting. This is known as Fibonacci. Those of you who have not read about Fibonacci before, again, a small homework for you all. Trust me, you will like the entire topic. It is very, very interesting. Let me just hold on 1 minute. I'm just getting a couple of messages saying that they could not hear me. I'm sorry, just 2 minutes. I think some of them are not able to hear me. Yeah. Hi, I hope everyone's able to hear me now. I think there was some audio issues that some of you all were facing. There is also click to reconnect on the top if you all can find it. It will refresh the video and the audio. All right, all right. Some of you all are responding saying that you can hear. If there is anybody who cannot hear, please send me a chat message. All right, looks like everyone can hear. I'm really sorry about that. I think there was some technical glitch. All right, let's come back to Fibonacci. Yes, so Fibonacci is very, very interesting. I would encourage you guys to go and do a little bit of reading on Fibonacci. But let me jump into why Fibonacci is important in the charts or in trading or investments. Let's see how the numbers align. Basically, Fibonacci is a series of numbers. It starts with 0 and 1. So basically, you add your first number with your second number, you get the third number. So if you can see the series over here, it's 1 plus 1, 2, 1 plus 2, 3, 2 plus 3, 5, 3 plus 5, 8, and it goes on to infinite. Now, Fibonacci, basically, this is the series of Fibonacci numbers that forms using your first number with the addition of the second number. And why is Fibonacci important? Because it pretty much appears everywhere in life. Now let me just move on and show you a couple of examples. All right, so there is, okay, Fibonacci sequence, also known as the golden ratio, appears a lot in nature. Patterns such as spiral in shells, curve in waves, seed heads, pine cones, branches of trees, all can be described using the mathematical sequence. The fact that things are large as spirals of galaxy and as small as DNA molecules follow the golden ratio rules suggests that Fibonacci sequence is one of the most fundamental characteristics of the universe. Now, basically what it says is that whatever you look at, whatever structure, whatever living things that you look at, everything has a Fibonacci sequence to it, and pretty much it makes up our entire universe. Let's look at a couple of examples. So there is basically a geometrical representation of Fibonacci. What they've done in this geometrical representation is they've just added 1 plus 1 box square, and you get the second box, second square. 2 plus 3, you get the entire 5. And they all fit in perfectly well. All the boxes that gets created by adding, for example, 3 plus 5 fits in exactly to this entire sequence of numbers. And 8 plus 13 fits in exactly here with 21 with the sequence of all of these numbers. And this can go on again infinite. Now, if you look at it, if you just connect the corners of each of these boxes, it kind of creates a spiral for you. Same thing again appears in trees. Most of the tree branches sprout out in Fibonacci numbers. Basically, each branch will branch out in a particular series of numbers so that every leaf on the tree gets the required sunlight. And that is how the nature has been created, and it all aligns with the Fibonacci sequence of numbers. Now, again, this is theory. You can still go back home and do some practicals on this. Trust me, I've done a lot of practicals, and most of it actually does fall in line. Now, moving ahead, now this is the entire galaxy that you can look at. And if you add Fibonacci to this, there is a Fibonacci ratio that also comes into our entire universe, right? So why am I showing you all of these is because if Fibonacci appears in nature and in geometrical representation, there is Fibonacci numbers that is used in algorithms, right? So everything that we do has Fibonacci series into it. If that is the case, why not in the stock market, or why not on the charts that we look at on the stock pricing? Can we use Fibonacci numbers to look at something which is familiar, or can we use the Fibonacci numbers to identify a good trading opportunity in the markets? And that is what we are going to look at right now. Now, there's another interesting fact. There is something known as the golden ratio in Fibonacci. All right, let me go back to the Fibonacci numbers. If you'll have your mobile phone with you, and if you're watching me from your laptop, this would help. Just open your mobile phone, open the calculator. Excuse me. Yeah, just open your calculator. Let's find the golden ratio from these series of numbers. Okay, I'm going to open my calculator here with me on my screen. I don't think you guys will be able to see it, but you can do it with me. All right, let's take two numbers. Let's take 233 divided by 377. 233 divided by 377, and I'm trying to derive a ratio out of these two numbers. Into 100, you should get 61.8, or you will get 61.8. Okay, let's do that again on probably a bigger number. Let's look at probably 196,418 divided by 317,811 into 100. Again, you should get 61.8. I'm guessing all of you all have tried this out, and you should be getting it. All right, so basically, if you take any of the number from the series, you take, let's say, for example, 2584 divided by 4181 into 100, you get 61.8. Now, again, this is the ratio that we have derived using those numbers, and 61.8, like I mentioned earlier, is the golden ratio. Now, since it is in percentage, now this will help me use this in my charts, because on percentage wise we only gauge the market in terms of percentage movement. You will, if you read any news, it will always talk about how much gold moved today. Gold moved up by 3%, gold dropped by 3%, right? Everything is in percentage. So hence we need the ratio to derive the percentage that we can implement on the charts. Now let's look at a couple of examples. Again, I'm just showing you on a static image right now. After this, I'll be doing the same thing on the live charts as well. Now let's look at this particular example. This is Apple. All right. Now I've taken data of a weekly data, so I'm looking at data all the way from 2019 till date. If you notice, Apple had given a big drop at this current level, and then it moved up a little bit, gave a drop, it continued moving up, gave a big drop, continued moving up. Now, as an investor, what do we always look at? We always look at the best buying opportunities or the best selling opportunities for us to take advantage of the market. Now, if I want to take advantage of a drop, how do I identify which is the good entry point? Apart from me studying Apple's fundamentals, if I have to look at it technically, what would be a good indicator? Now we looked at RSI. Probably RSI shows you oversold, so it indicates a good buying opportunity. But probably RSI could also show oversold at this particular candle here, and it moves up a little bit, but then it continues dropping again, right? So a combination of RSI, ATR, and Fibonacci could get you a much more clearer view. You can always use Fibonacci from your draw tools. In this case, I've already drawn the Fibonacci. I'll do that live again to teach you all how to use it. So basically, I've measured this entire rally before I saw the bigger drop that came in. So this was a small drop. This has been a bigger drop. Now, if I just measure this entire rally, it is 0 to 100%. So this entire rally is a 100% move. And from that 100% move, we are expecting, we are seeing the market come down. As it comes down, I'm looking at a good buying opportunity. So if you look at it, of this entire 100%, this is where 61.8 comes. That is by default. It comes on your platform. I will show it to you all again on the live charts. If you notice, it has taken a support, or the prices have started bouncing back up exactly around 61.8 levels, and it has made a new high currently. Now, it is not always as clean as this, but then most of the time 61.8 acts as a very good buying opportunity, or it indicates a good level to enter. Now let's look at this small rally over here. If you measure this rally alone, and this drop, if I take this entire rally as 100%, this drop is a drop of 61.8. Again, I will show it to you on the live chart. Let's move ahead. Now, this is on a daily chart. Earlier, we were looking at a weekly chart on a very long-term time frame. Now, I'm looking at a very short-term time frame. I see a good rally that has happened here. This is from 20th of July. And then the market dropping back down. And this is where the price is today at 112, probably a little more higher right now as we speak. If you notice, if this was the entire rally of 100%, the 100% move, 61.8 has acted as support. So whoever is looking at a short-term investing opportunity, this price would have been a good time for them to enter. I'll give you another fun fact about 61.8 since we've reached looking at it on the charts. Now let's take an example of my entire height. If my height is 100% from my total, my head, if you take my entire measurement as 100%, my hip bone, from my hip bone till my toe will come as 61.8% of my entire height, which divides my upper body and my lower body. Why am I telling you this? Is because we all know that it is very crucial. Our hip is the most crucial part of our entire body, because it keeps both our upper body and lower body in balance, right? Let me give another example. You guys can try this at home if you all have a measuring tape. measure your entire arm length from your shoulder till your fingertip. Okay, if your entire length is 100%, your elbow to your finger, the entire length would be 61.8% of your total 100% length. This is something that you all can try at home, and please drop in a chat message if you all are doing it right now, or probably get in touch with us later and see how the experiment went. But the important part is, why am I telling you about all this? Again, my elbow is a very crucial point for my arm, because that acts as a pivot so that I can lift things, and that is how we are designed. Now, the entire universe, like we discussed, has these numbers, the Fibonacci numbers, and our own human body has Fibonacci numbers. Now that we saw, even the charts on the charts also reflect Fibonacci series that is happening. I think some can't hear me again. Okay, no, it's perfect now. Yeah. Sorry, yeah. So even the charts has Fibonacci numbers into it. Let's move forward to the live charts. Before we'll move to the live charts, and then we'll come back to the harmonic patterns. Before I move to the live chart, does anybody have any doubts? I'll try and answer one or two questions quickly before we move on. Sorry, there's just a one directional conversation. And I'm not sure if you're with me so far. Anybody, any questions? All right. Looks like we don't have many questions yet. Let me move to the live chart. All right. So now let's go to our RSI. ATR, and later come to Fibonacci. Now again, I'm looking at a RSI chart here. Let me make this into a 5-minute chart. So basically it will show me the movement of how it is happening on a 5-minute time frame. Now, if you look at most of these peaks, you see there's a downtrend in the market. Then again, it makes a new peak, and then there's a downtrend in the market, and vice versa. Every time there was a oversold region, you see an upside move that comes into the gold chart. Now I'm looking at a 5-minute chart. So on a 5-minute chart, it is not advisable to trade. I'm just showing it to you on a 5-minute chart because we have more data points that we can look at. Let's also look at a 4-hour chart. This is a little longer time frame, right? Let's look at the last few times it has gone to overbought and oversold. So if you look at these regions, it's showing oversold. So that means this makes it an ideal place for you to buy gold. But then the question is, if you buy gold at this price, what level of price are we looking for gold to move? So you always look at the ATR at that point of time. Now I'm looking at a 4-hour chart. As I mentioned to you earlier, on a 4-hour time frame, gold can move about $12. Let's take an example of buying gold at current price. I'm just going to do 10 units, which is about $18,000. I can always set my take profit of $12 on the higher end. So I can expect gold to move up by $12. At the same time, you always keep a stop loss of $6 on the lower end, right? So in this case, you're buying 10 units of gold. You're keeping a take profit of $12. So that is 10 into $12. Okay. At the same time, you're also keeping a stop loss of $6, which is 6 into 10. That will be $60 loss, right? Now, let's say if this is too risky or if it is too low, you can always increase your number of units. Let's say we increase it to 20. The price level remains the same. It's still $12, but your profitability and your risk increases along with the number of units. If you noticed, the account value is $100,000, and we've taken, if we are going to be taking this trade, we are taking a trade worth $37,000. This is something that you need to keep in mind every time you take a trade, because right now you're investing with the amount you have. We can, since the platform provides leverage, you can also go beyond what your account value holds, and that is where the risk needs to be addressed if you do not have a stop loss. Now let me show you another example. Let's take a look at a different instrument. Let's go to SPX 500. Now, SPX 500, for those of you all who do not know what it is basically top 500 companies of US put into one index. So instead of everyone following 500 big companies, you can just follow the index to see how the market is performing. If the index is performing well, that means the overall performance of US stock market is healthy. Any news article that you read, they will always refer you back to SPX 500 performance. If you look at a yearly data on how markets have evolved, it will also still speak about SPX 500 because it captures the broader markets of US. Now let's look at SPX 500. Let's look at an hourly chart. SPX 500 on an hourly chart is indicating that it is at an overbought region. So if anybody had to take a buy, let me draw this at the oversold region. So this was the oversold region, right? So this gave a clear indication that it has been in oversold region and it can start going back up. And if you had to invest at this price, this would be an ideal place to book the profit. Actually, ideal profit could be anywhere from this range to this range, right? So now your RSI not just gives you an entry point, but it also gives you an exit point. Again, let's do a trade on SPX. Assuming that the blue line is where we're going to enter. The green line is where the profit, ideally, if anybody had to buy it at the blue line, this is where the profit would be, and a stop loss would be on the lower end. Now again, you can put a stop loss below. So that's about $11. That is my ATR, and probably let's say $22 on the higher end, right? So this is what my ATR had given me. But then if I had to follow my indication on RSI and wait to book my profit till it goes to overbought, I could always wait till it reaches the overbought region, and this is where it had gone to overbought, somewhere here. And this could be your ideal profit and loss. So you risked about $110, but you gained about $783. So RSI on these basis gives you a good indication. One thing to keep in mind is, even if you take trades based on technical analysis, always make sure you read the news and you also are updated about the current fundamentals in the market, because anything could always change direction. If there is a strong statement that is made by US, if there is any strong statement that comes out in regards to COVID-19, if there is any geopolitical uncertainties that is going on throughout the day, the market could at any given point of time turn around and go against you. So hence, stop loss is always a must, even if you get the best indicator to enter. Now let's look at Fibonacci. Let me show you Fibonacci on SPX. I'm just going to close RSI and the ATR. Let's look at a weekly chart on Fibonacci, or even a daily chart would do, right? Now, there are key things that you need to note while drawing Fibonacci. you always need to find a good significant rally or a significant drop. We need that 100% move before the trend has changed. Now let's look at few areas where the trend has changed. Let's look at, so there was a very big shift in the trend at this point, and then again there was a very big shift in the trend at this point, where it went till here, where we saw a good downside. The trend continued again towards the upside, and this is where we are at currently. Now let's just look at the current market movement. I'm going to change my candlestick to Heikanashi. Heikanashi is something where you can see trend in the market. If you look at the candlesticks, now it looks a little different. It shows you the trend. So basically there was an upward trend which had a pause at this level, and the upward trend continued from this region onwards. You find your Fibonacci in your draw tools at this level here. So I'm going to remember the example of my height that I gave you. So basically we are looking at a good height. Like for example, for me, it's my head to toe. So if I'm trying to look at a rally to identify a good entry point on a short run, I'm going to identify a good rally that happened recently and not my entire past, because I need to take a decision for, let's say, on a shorter time frame, or probably for the next 6 months, or even probably for the next 2-3 weeks, right? So I'm going to look at data probably from June onwards, because this was a good upswing where there was a sideways movement, and then the upswing continued. So I'm going to choose my Fibonacci from my draw tools. Select your bottommost point to the highest point where SPX has moved. I hope everyone's getting the Fibonacci, how to draw Fibonacci here. I have not, if you notice, I have not taken right from the bottom here. However, even that could be done for a very, very longer time frame. But I am just looking at a small time frame, probably for the next couple of weeks or couple of months. Now I'm going to just take this. This is going to be my entire 100% move. If you notice, market had started dropping, and it took support from a particular level here. And as of today, the market has started going back up. Let's look at what this level is. If you go back, this level matches up to 61.8 again. Now, I know 61.8 looks very magical, and it looks like every 61.8 is a buying opportunity. But however, that is not always the case. There are few things that we need to keep in mind while we are drawing Fibonacci. Now, as per my analysis, I found this level to be a good point to draw my entire 100% upside move on Fibonacci, whereas some could also consider the downside of the entire move, and they would rather wait for the markets to drop down much more further before they start buying into it. Let me give you another example. Let's look at Apple, since Apple is the most favorite stock for everyone. Let's look at how Fibonacci worked out for Apple. Okay, I've already drawn it over here. I'm going to close all of this. I'm going to take Apple from like way back in history. Let's say if you were looking at investment perspective and not trading perspective, I'm going to take a monthly chart. Okay, so we have a monthly chart here, starting all the way from 2009, 2014, 2019, and till date. Okay, now it's easy for me to identify. Again, I'm using a different type of candlestick. It is known as Heikanashi. Okay, this is your normal candlestick. This is how it looks. It has a lot of red and greens, but it does not show you clear trend. But if I use Fibonacci, it shows you a clear trend. Now, along with this clear trend, it also shows us a clear drop. Everywhere there has been a drop in the market, right? So these are some good drops that we've seen. Now, as per my Fibonacci, or at least the rule of Fibonacci is, we need to identify a good rally to draw the entire Fibonacci, so that when the market after the market starts dropping, now we know the market has taken a change in trend to identify a good level to buy. Let's start looking back in history. I think let's start from this point. Market went up from here till this point. Close the others. Oops. Let me just close the circles. All right. So this was a rally that happened. I will remove the unwanted numbers for now. Yeah. So if you all can look at this particular chart, so basically, market rallied up, it came down. In this case, it did not touch 61.8. Okay. So hence, you would not take a trade. If you're following the rule of Fibonacci, you wait for a good entry point. If the entry point does not come, you do not force a trade or you do not force an investment. However, if you are looking at a very long-term view on Apple and you believe in the fundamentals of Apple and you want to hold on to Apple for the next 5 years, there is no harm entering even before it touches 61.8. But the rule is if you can use 61.8 as a good entry point, which will always work out for you. Now let's look at the next rally that happened. This was the next rally that happened. Now in this case, it went, market had taken a turn, it came down, it touched 61.8. So now it gave you a good indication as to a buy price, or it gave you a good entry opportunity for Apple. Now let's take it further. Let's take at this particular rally, this rally that happened. Okay, this drop is February, March, when the pandemic was at its peak, or at least the market drop was at its peak. Uh, Again, I'm taking the bottom of this rally to the top of this rally. If you look at the chart, it again came back to 61.8 before it started jumping back up. And currently we are here. We are at this particular level. We have seen some drops that has come into the market. Right? We are looking at a drop that is coming. So anyone who has not yet bought into Apple could wait for 61.8 again before you enter. So 61.8 basically gives you a good level to enter, and instead of trying to buy, buy Apple right at the peak. So any questions on Fibonacci so far? Do you want me to do the illustration again on Fibonacci, how to draw it? I can do that. You can just drop in a message on the chat. Yeah, I've got, all right. So there was a couple of questions that came in earlier. I could not answer. Let me see. Someone had asked me, does 61.8 level act as a support? Yes, it does. It can be used as one indicator. You can always combine RSI, and like I told you all, you have a lot of technical indicators at the bottom. You can use a combination of many to identify or to get 2 to 3 signals for entries. However, using too many signals would basically confuse you a lot. So I would always suggest identify those 2 3 indicators that works well for you. Practice is a must. Practice as much as possible on your demo accounts before you take trades on these indicators, because there are a lot of other factors that always influence the markets. It's always practice that helps you identify those unseen moves that could potentially come into the market. However, if you follow the rules with your risk management in place, with your stop losses and take profit, and without altering any logic after you have entered. Let me give you an example. Let's say I bought Apple at 61.8, and after I bought it, I Now in this case, Apple went up easily about $10 to $15, right? Now, if I've bought Apple, I look at the ATR. I'm looking at a monthly chart. On a monthly chart, probably Apple moves about $30 to $40. But if I buy Apple at 61.8 and I keep a take profit of $40, I'm going to stick to that $40 as my take profit. Usually, what happens is a lot of people or a lot of traders get carried away with the more upside momentum on Apple. They buy it at the right spot, they book the profit too early, and they might end up buying right at the top where the market could potentially drop back down again. So, those are something that should be avoided. Every trade that you take should have a decision based on a logic and based on fundamentals and technical reasons for you to enter. And once you entered on that particular reasoning, unless there is a major fundamental shift in that particular stock, I would not recommend you to change take profits or change stop losses for you to take advantage of the system as it gives you the signals and signals for entries and exits. A few other questions. Some questions what is the best time to buy and sell? There is no best time as such, but there are good levels that a stock can give you an opportunity in. I think Fibonacci would be one of the good indicator for you to understand what would be the best level to buy and sell. Now, best time to buy and sell again depends on investor to investor. There would be people who are looking to gain probably on a daily basis. There would be people who are looking to gain 5 years later. So the time frame depends on each individual's vision for their account. I would also recommend what I'm teaching you here is more on a basic level. I would recommend you always get in contact with your respective consultants and go through all of what I'm teaching you because your requirement might be completely different from what I'm showing you here. Of course, you can use the same technical analysis, but you'll need to understand your objective of every trade that you're taking, especially if there is leverage involved into the account. Let me just show you one last interesting thing that you can get out of Fibonacci. There is something known as harmonic patterns. Let me just share the screen on harmonic patterns. Yeah. All right. So coming to harmonic patterns, basically these are geometric patterns that appear using Fibonacci ratios alone. Again, now let me show you an example. So harmonic pattern, basically there was a person by the name of Gartley who kept watching these patterns appear and reappear. And why do these patterns appear and reappear? It's because of the trading psychology. There's always fear and greed that runs investor's mindset. Now, every human being at one point of time behaves in a particular pattern, and hence these patterns are identified looking at the charts. Now, these patterns also help you identify when what you can buy at what price you can buy, not what time though. Now let's look at one pattern here. It's called bullish Gartley pattern. I'll try and make it easy. Just imagine X and A as a stock price that is moving up. So basically stock, let's say stock A has moved up from point X to point A, and from there it has given a drop. So as per the bullish Gartley pattern, when you draw your Fibonacci from point X to point A, it has to come down to 61.8. So X, A, and B will be confirmed. However, we will not take any trade on B. We will not take any trade on A. We will wait for D to complete. So once B is confirmed, you draw a Fibonacci from A to B and expect the prices to move back up. and this upside movement should be between 38.2 and 88.6. Again, these are other Fibonacci numbers. 61.8 is the golden ratio. You divide your first number with your second number, you get 61.8. You divide your first number with your third number, you get 38.2. You get 88.6 is basically square root of 61.8. So there are a lot of other numbers in Fibonacci. Again, I will not get into detail for each of these numbers, but it is there in your drawing tools by default, where you can select all these numbers without calculating it. Now coming back to A and B, if the price goes back to between 38.2 and 88.6, then your X, A, B, and C has been confirmed. Now you just need to wait for the D to happen. Now the D can happen in two ways. You measure B to C, you measure this entire height between B to C. It should come down till 127 or 161.8 of B to C, or X to A should come to 78.6. So if B to C and X to A converge with point D, the probability of this price going in your favor becomes 80 to 85% probable. Now, this looks really good, but identifying these patterns takes a lot of skill and time. And of course, you have your consultants who keep looking at the charts the entire day. They will identify it for you. But what I would encourage you to do is identify it yourself, because in that way you can identify more opportunities. And this particular pattern does not necessarily have to be applied to stocks. It can also be in commodities, it can also be in currencies, and it can be in indices. You can use Fibonacci on pretty much anything that you can trade on the platform. Let's look at another type of pattern. The only difference between these two, there are more patterns, and I've just kept two as an example for now. The most used one is Gartley. Bullish bat also keeps appearing a lot. If you notice, the difference between these two are very little. So in this case, B ended at 61.8. In this case, the B should end anywhere between 38.2 or 50%. Okay, and the C remains the same. But the D again differs. D has to be between 261.8 or 168.2, or XNA of 88.6. Now, luckily, just a week back, we had a good trade that we got on a bullish bat pattern. I will show that to you on the live chart. Yeah, so let's look at a pattern and how the pattern looks on a live chart. So this pattern had appeared on Germany. They have kind of already drawn it over here, but then let me start it from the beginning so it's easier for you all to see it with me. All right, so basically the pattern looks somewhat in this manner, right? This is what the pattern looked like. Now, the challenges are these patterns falling into the Fibonacci that we just looked at least the Fibonacci numbers. Now, let's go one at a time. So I'm going to use Fibonacci. This is going to be my X, and this is going to be my A. So point A to point B. If you look at this particular rally, it has gone up till here, and it came back to a certain level before it jumped up again. So I'm going to take this as my B point. This, if you look at it, it has come back to 50%. So the minute it comes to 50% and it jumps back up, I already know it is not a Gartley pattern, but it could be a potential bat pattern. Now, however, just because the B has taken support does not necessarily mean it's a pattern. We need to wait till even C and D completes. Now, let's look at A to B. Now, if you look at A to B, it is gone back up to this level here and it drops again. Now, if you look at where it had gone, according to this particular pattern, it has to be between 88.6 and 32.8. So it is at 78.6. So this also could still be considered as a pattern. Now we have one more point that has confirmed. So this point has confirmed. We had X, we had X, we had A. This is A, this is B, and we got C. Now, one last move that we need in our favor is the D move. And if D happens exactly as per what we had seen it on the patterns, let me open bullish bat pattern so you all can see it along with me. Okay, so this is Gatley. Just okay, here's the one. Here's the bat pattern, right? So we are looking at this. So X, A, B is completed, C is completed. That was between 38.2 and 88.6. So that is here at 78.6. Now B to C needs to complete at 168.2 or 88.6 of X and A. So let's check X and A. So this is my X, this is my A. It has completed somewhere here. Okay, so let's go back. That is 88.6. So X and A has shown me that D point has completed. Just for me to double confirm, I will also check my B and C. So let me close this. So as per B and C, I'm going to take from this point to this point here. It is showing 161.8 or 168.1. So as per the bullish bat, it needs to be at 168.2. So we are somewhere there, 168.1, 168.2. So this is colliding, whereas X and A has to be at 88.6, also has converged. So now this pattern here has been officially completed. So what does this determine? That means the trend of this particular instrument is going to change and it is going to give you an opportunity to invest into. So people usually buy into this. Let me just show you on the chart. Let's say I buy 10 units of Germany at the point D. What you see here, you're buying it at point D, expecting it to go back up. Usually when the upside movement begins, it goes back close to C or even A. So let's look at our stop loss and take profit. So I'm going to keep my stop loss below the pattern, always below the pattern, because if the price moves beyond the pattern, that means the pattern has failed. But if the price takes support and starts moving in my favor, I can expect it to go back to either the B point or the A point. I don't want to be that greedy, but then let's say it goes back halfway or again 61.8% on the higher end of this entire drop. So I'm risking again, let's say about 2000, or let's just make it 1 unit. Let's keep it within the account value. So I've risked about $1,000 to make about $3,600. So this is actually a pretty good risk reward ratio. However, if you still aim for the highest point of reward, you're still risking $1,000, and you can make about $5,500 on the upside. So, and that is how Fibonacci's are used to identify the patterns. We have many patterns. One is the Gartley pattern. There is bullish bat. There is butterfly pattern. There is scrap pattern, and there are many more patterns that you can identify within these charts. But this is one that had happened recently, and it was a good example to show you all today. I hope this was not too much of information today. What I would recommend is just go back and do a recap on what RSI is, on what ATR is, and on Fibonacci. Do not worry if you did not get everything that I told you today. We can always have a one-on-one session, or you can get in touch with your respective consultant. They will be happy to help you out with whatever I've shared today. Again, please go back and do your own homework. What we've shown here is very, very basic. There are a lot of other factors that you need to consider while investing. One is how much of investment needs to go in what strategy that you're looking at. If you're looking at a short-term strategy, there are different things that needs to be considered. If you're looking at a long-term or a longer time frame or an investment strategy, there's a different set of factors that you need to look at. Everything has its own ups and downs. It's always best to understand the risk involved with every type of strategy that you're going to be investing into, and all your questions will be answered by your respective relationship managers or your consultants. I would encourage you to call them back, and please start sharing your questions so that they can get in touch with you, and probably schedule meetings with them or with your respective consultants. I hope I was very easy to understand and it was clear for you all. Thank you all so much for taking time and joining us out on this session. I would wish to communicate with you on a two-way direction, but then unfortunately we are not able to do that till this certain. We have the webinar right now till the COVID cases reduce. Once the cases reduce, hopefully we will have live seminars where we can interact one-on-one and make this more fun. Please write comments and let me know how the session was, and we would look for your feedback. Thank you so much again for your time. Have a great day. Take care.